is NURIN. Today I will be talking about the central bank. Central bank is a financial institution in any nation economy. It is responsible for managing monetary policy, regulating the financial system, and ensuring economic stability. Some well-known examples like the Federal Reserve in the US and also the Bank of England, and our home is Bank Negara Malaysia. The importance of central bank is to conduct monetary policy and control the money supply. Without the central bank, economies would struggle with financial instability and inflationary pressure. Now let's focus on our central bank, which is Bank Negara Malaysia (BNM). Bank Negara Malaysia was established on January 26, 1959 under the Central Bank of Malaysia's Ordinance of 1958. It was created with the primary goal of promoting monetary and financial stability. The governor of the central bank is appointed by the Yang di-Pertuan Agong. Meanwhile, the deputy governor appointed by the Minister of Finance, which is Anwar Ibrahim, and Datuk Seri Amir Hamzah Azizan serve as the Minister of Finance too. Their leadership ensure that the governance of Bank Negara Malaysia aligns with the country's economic goal. The objective of Bank Negara Malaysia is Bank Negara Malaysia responsible for issuing the national currency, the ringgit, and ensure its value is safeguarded. Bank Negara Malaysia acts as a banker and financial advisor to the government. It manages government accounts, provide expert financial advice, and help in drafting policy that align with the currency economic goals. Bank Negara Malaysia also promoting monetary stability and ensuring a robust financial structure by formulating the implementing effective monetary policy. Bank Negara Malaysia maintain low inflation and foster a healthy financial system to support sustainable growth. Bank Negara Malaysia also play a vital role in ensuring the reliability, efficiency, and smooth operation of national payment and settlement system. This is crucial for facilitating everyday transaction and supporting the economy's financial infrastructure. Bank Negara Malaysia also work to influence credit distribution to benefit the nation. It implement policy that direct credit to productive sector of the economy, ensuring that resources are used effectively to support Malaysian development. This objective ensure that Bank Negara Malaysia fulfill its mission of maintaining economic stability and contributing to the sustainable growth of Malaysia's economy. Organizational structure of Bank Negara Malaysia is designed for efficient management of its responsibility. At the top is the governor, the chief executive officer, supported by 2 deputy governor and 5 assistant governor. The bank is organized into 5 key divisions. First, the economic key that focus on research, analysis, and policy making. Second is the investment and operation division. It manages reserve and operational activity. The organizational development division that handle human resource and internal development. Fourth, the supervisor division. It ensures financial institutions comply with regulation. And the last one is the regulation division. It develops policy for stable financial state. This structure ensures Bank Negara Malaysia operate effectively and meets its objective with accountability. Bank Negara Malaysia play a key role in Malaysian economic stability through several critical functions. First, the bank for currency issue. It manages the printing, circulation, and secure storage of currency for ensure sufficient supply. Second, as the keeper of international risk, it maintains the country reserve, including gold and foreign exchange assets to support financial stability. Third, as the government banker and financial advisor, it manages government accounts such as check payment, and it also accepting and transferring fund and source of fund to government cover any deficit in budget revenue. It also advises on debt management. Fourth, promoting monetary stability and influence the credit situation. It controls inflation, adjusts the money supply, and ensures sustainable economy. Lastly, as the banker to bank, it regulates financial institutions, oversees currency distribution, and provide emergency liquidity to prevent systemic risk.
How does the central bank control the money supply? For example, our Bank Negara Malaysia. Monetary policy means that the central bank, which is Bank Negara Malaysia, having the control over the money supply and maintaining our country's economic growth. There are 2 instruments which is quantitative and qualitative instrument. Quantitative tools in monetary policy involve measurable actions taken by central banks to influence economic activity, primarily focusing on money supply and interest rates. These tools include open market operations, discount rate, and reserve requirement setting. On the other hand, the qualitative tools is known as a selective method. For quantitative instruments, the first is open market operation, the second is required reserve ratio, and the third is the discount rate. The open market operations involve selling and buying securities, and they buy from the government and sell them in the financial market. In the open market purchase, it involves 2 parties, which is the central bank and the commercial bank. In this example, the commercial bank is known as Bank ABC. So when the central bank buys 5 million of government securities, Bank ABC will decrease by 5 million on its account. This is the T contract account shown by the central bank and the Bank ABC. The central bank will gain 5 million asset, while the liabilities will also gain 5 million. But for Bank ABC, the government securities will decrease, but it will increase at the central bank instead. This will also directly increase the money supply. For the example of the open market sales, as the central bank sells 5 million of government securities back to the commercial bank, here which is Bank XYZ, the commercial bank will pay the amount by reducing its reserve at the central bank. When the reserve is reduced, the money supply will also reduce. This is the open market sales T accounts. When the central bank sells the government securities, its asset will reduce by 5 million, and the liabilities at reserve Bank XYZ will also reduce by 5 million. But for Bank XYZ T accounts, the government securities will increase by 5 million, but the reserve at central bank will decrease by 5 million. As a conclusion, for open market purchase, when the bank reserve is increased, the money supply will also increase. And the formula is 1 over reserve ratio for the money supply. For the open market sales, when the bank reserve is decreased, the money supply will also decrease. So how does the open market operation affect the money supply? So when the central bank purchases government securities, this will increase the reserve and increase the money supply. But when the central bank sells the government securities, it will increase the reserve and decrease the money supply. This is important to control the inflation and deflation rates of the country.
Hi everyone, and good morning doctor. My name is Hanis Nasuha with Husmidi. My matrix number is 301795. Today, I want to present about the required reserve ratio. The central bank can influence the money supply by changing the required reserve ratio. Required reserve ratio is the minimum percentage of deposit that depository institution must hold as reserve, either as deposit at the central bank or in bulk cash. Change in reserve ratio will affect the ability of banks to make loans and thus the money supply. Maximum change in deposit can calculate like 1 divided with required reserve ratio times with change in reserve. For example, if reserve increased by $1,000 and the required reserve ratio is 10%, then the maximum change in demand deposit or increase in money supply 1 divided with 0.1 times with 1,000 equals 10,000. If the central bank increased the required reserve ratio from 10% to 20%, the amount of demand deposits or the money supply declines 1 divided 0.2 times with 1,000 equals 5,000. Thus, an increase in the required reserve ratio leads to a decrease in the money supply. A decrease in the required reserve ratio leads to an increase in the money supply. The discount rate. Banks that are short of reserve can make loans from the central bank or in the federal funds market. The interest rate it pays for a loan from the central bank is the discount rate. For example, the interest rate the central bank charges depository institution that borrow reserve from it. Federal fund market means a market when banks lend reserve to one another, usually for short periods. Federal fund rate is the interest rate in the federal funds market. The interest rate banks charge one another to borrow reserve. If the discount rate is lower, below the federal funds rate, banks will borrow from the central bank. Meanwhile, banks receive increase, thus increase the reserve of the banking system and so the money supply increase. If the discount rate is raised above the federal funds rate, banks do not borrow from the central banks. The banks pay back their loans that they previously had taken out, so reserve fall and thus the money supply declines. Here is fact tools to change money supplies. First, we can see there are open market operation, and the second is required reserve ratio, and the third is discount rate. For open market operation aspect, we can see there are two elements, which is open market purchase and open market sale. For open market purchase, it will lead to money supply rises. Meanwhile, for open market sale, it will lead to money supply falls. In the required reserve ratio aspect, if it's lower, it will lead to money supply rises. Meanwhile, if it raises, it will lead to money supply falls. For discount rate, if discount rate is lower, and then the money supply rises. Meanwhile, if the discount rate is rises, then the money supply will fall. So now we'll go through with qualitative credit control. Margin requirement. The central bank can order the commercial banks lend to an amount lower than the value of a security. The higher margin used during inflationary situation will reduce the amount of loan given by the banks. Rationing of credit. Credit rationing is a method of controlling and regulating the purpose from which the bank grant credit. Regulation of consumer credit. The central bank can regulate the terms and conditions under which consumer credit is to be given by the banks. For differential rate of interest, under this scheme, the central bank fixes up different rates on interest to be charged by the banks from different borrowers who borrow for different purposes. Mortgage persuasion. It implies persuasion and requires made by the central banks to commercial banks to follow the general policy of the central bank. Direct action. Direct action refers to all the controls and direction which the central banks may enforce on all banks or any banks, in particular concerning lending and investment. So the next part is money supply curve. Through the money supply curve, we can see if the fact money supply behavior is not influenced by the interest rate, the money supply curve is a vertical line, which is an S0. If money supply increase, then the money supply curve will shift to the right. It's referred to MS1. And if the money supply decrease, money supply curve shift to the left, which is referred to the MS2.
Interest and interest rate. Interest rate is the fee that a borrower pays to the lender for the use for his or her funds. Firms and government borrows funds by issuing bonds, and they pay interest to the firms and households that purchase those bonds. While interest rate is the annual interest payment on a loan expressed as the percentage of the loan. For example, we purchase a 2,000 ringgit bond that pays 150 ringgit of interest each year, has an interest rate of 7.5%. Next is nominal and real interest rate. Nominal interest rate is the interest rate without any correction for the effect and inflation. So the interest rate that we see on bonds, loans, or in bank account is usually a nominal one, while real interest rate refers to the interest rate it has to remove the effects of inflation that describes the real cost of borrowing money. Formula for real interest rate is nominal interest rate minus expected inflation rate. The demand for money. Demand for money depends negatively on the interest rate. So the higher the interest rate, the higher the opportunity cost from holding money. So the curve will slope downward. When the interest rate go higher and quantity demand for money will go lower. There are three motives for holding money. In transaction motive, the reason people hold money is to buy things. And the main factor of demand for money is income. So income and demand for money has a positive relationship. And this motive does not influence by interest rate. Precautionary motive is the desire to hold cash in order to be able to deal effectively with unexpected events that require cash outlays, such as medical care, for example, got admitted to the hospital. The demand of money holding positively when income related, which means when income increase, money demand will also be increased. In this precautionary motive also does not reflect on interest rate. In precautionary motive, the money demand depends on three things: interest rate, aggregate output, and aggregate price level. Lastly, we got speculation motive, which one reason for holding bond instead of money. This is because the market price of bonds is negatively related to the interest rate. That is when the interest rate is high, the price of bonds is low. So the people prefer to hold the bonds when the interest rate increase and sell the bonds when the interest rate decrease. Thus, the relationship between demand and speculation motive and interest rate is negative. Next is equilibrium in the money market. The demand curve for money have the inverse relationship between the quantity demand for money and the interest rate. The money supply curve has the vertical line and is totally inelastic. The quantity of money supply is fixed, so is the supply of bonds. So the equilibrium in the money market exists when the quantity demanded of money ND equal to the quantity supplied MS. It's also an excess demand for money at any interest rate below the equilibrium rate.
This image illustrates the equilibrium in the money market, a critical concept in monetary policy the central bank keeps. The equilibrium is determined at the point where the money demand MD intersect with the money supply MS. The diagram shows that at high interest rates, the demand for money decreases while at lower interest rate, the demand for money increases. The money supply, represented as a vertical line, is fixed by the central bank. The intersection of MD and MS determine the equilibrium interest rate R0 and the corresponding quantity of M0. Monetary policy plays a key role in influencing this equilibrium. In an expansionary policy, the central bank increases the money supply, shifting MS to the right, which lower interest rate to encourage borrowing, investment, and spending. In contrast, the contractionary policy reduces the money supply, shifting MS to the left, raising interest rate to control inflation. The central bank uses various tools such as open market operation, reserve requirement, and policy interest rate to adjust the money supply and achieve economic stability. Initially, equilibrium occurs when the money supply curve MS0 intersect the money demand curve MD0 with an interest rate of R0. When the central bank increases the money supply, the curve shifts from MS0 to MS1, creating a surplus of money at the original interest rate. To restore equilibrium, the interest rate decreases from R0 to R1, encouraging borrowing and spending, which increases money demand. The new equilibrium is reached at MS1, higher money supply, MD0, unchanged money demand, and R1, lower interest rate. This demonstrates how increasing the money supply lowers interest rate and it stimulates economic activity. Initially, equilibrium is where the money supply curve MS0 intersect the money demand curve MD0 with an interest rate of R0. The money demand increases due to factor like high income, increased consumer spending also rises prices. The money demand curve shifts from MD0 to MD1. At original interest rate, a shortage of money occurs. To restore equilibrium, the interest rate increases from R0 to R1, which discourages borrowing and spending, reducing money demand. The new equilibrium occurs at MS0 and unchanged money supply, MD1 high money demand, and R1 high interest rate. This illustrates how an increase in money demand raises interest rates, helping restore balance in the money market. The money supply curve can shift into several factors leading to changes in interest rate. If the money supply increases while the money demand remains unchanged, the money supply exceeds the demand, causing interest rate to decrease. Conversely, if the money supply increases and money demand does not change, the money supply becomes less than the demand, pushing interest rate upward. The key factors that cause the MS curve to shift include the required reserve ratio, the discount rate, and open market operation. The decrease in the required reserve ratio of the discount rate will increase the money supply, while an increase in AD will decrease. Similarly, open market operation plays a significant role when the central bank purchases securities. The money supply increases whereas significantly decreases the money supply. Initially, equilibrium is where the money supply curve MS0 intersect the money demand curve MD0 with an interest rate of R0. The money demand increases due to factor like high income, increased consumer spending also rises prices. The money demand curve shifts from MD0 to MD1. At original interest rate, a shortage of money occurs. To restore equilibrium, the interest rate increases from R0 to R1, which discourages borrowing and spending, reducing money demand. The new equilibrium occurs at MS0 and unchanged money supply, MD1 higher money demand, and R1 high interest rate. This illustrates how an increase in money demand raises interest rates, helping restore balance in the money market. Initially, equilibrium is where the money supply curve MS0 intersects with the money demand curve MD0 with an interest rate of R0. When the money demand decreases due to factor like low income, reduced consumer spending, or falling prices, the money demand curve shifts from MD0 to MD1. At the original interest rate, there is an excess supply of money. To restore equilibrium, the interest rate decreases from R0 to R1, which encourages borrowing and spending, increasing money demand. The new equilibrium occurs at MS0, unchanged money supply, MD1 lower money demand, and R1 lower interest rate. This demonstrates how a decrease in money demand leads to lower interest rate, stimulating borrowing and spending until new equilibrium is reached. Shape and the money demand curve are influenced by real aggregate output income and the aggregate price level. If money demand increases while the money supply remains constant, it leads to a shortage of money, causing interest rate to rise. However, a decrease in money demand related to a constant money supply causes interest rate to fall. Real aggregate output plays a key role in determining money demand. An increase in output leads to higher money demand, while a decrease in reducing. Similarly, changes in the aggregate price level affect money demand, as higher price level increase money demand and lower price level reduce. It is important to note that changes in interest rate do not shape the money demand curve, but instead cause movement along the curve.